Let's start. Good morning, everyone, and welcome to the annual meetings and the Global Financial Stability Report press conference. It's so great to see you here again. I'm going to reiterate the message from my colleague who said it before. Great to be back in person. We also welcome our viewers online. I am Randa Elnagar of the IMF Communications Department. By now, you should have received the Global Financial Stability Report online, and we are going to be looking forward to having your questions. Before we start, let me introduce our speakers here. Tobias Adrian, Financial Counsellor and Director of the Monetary Capitals Department. Fabio Natalucci, Deputy Director of the Monetary and Capital Markets Department. And Antonio Garcia Pascual, who is a Deputy Division Chief in the Monetary and Capital Markets Department. Before we start, I'm going to kickstart the conversation with Tobias and ask him a couple of questions to get this conversation going. So Tobias, how do you assess global financial stability currently with very high and persistent inflation and, of course, asset price volatility?
Yeah, thanks so much, Randa, and it's great to see you all here in person. Global financial stability risks have increased with a balance of risk that is skewed to the downside. Amid highest inflation in decades and extraordinary uncertainty, markets have been extremely volatile. Risk assets such as equities and corporate bonds have declined sharply. A deterioration in market liquidity has amplified price moves, and financial conditions have tightened globally. In many advanced economies, financial conditions are now tight by historical standards. In some emerging markets, they have reached levels last seen during the height of the COVID-19 crisis. With conditions worsening in recent weeks, key gauges of systemic risk, such as higher dollar funding costs and counterparty spreads, have risen. There's a risk of disorderly tightening in financial conditions that may interact with pre-existing vulnerabilities. Investors may further reassess the outlook if inflationary pressures do not abate as quickly as currently anticipated, or if the economic slowdown intensifies.
Okay, Tobias, thank you. What is the most important development that you are thinking about right now and watching?
While in emerging markets, rising rates, worsening fundamentals, and large outflows of capital have pushed up borrowing costs notably, the impact has been especially severe for more vulnerable economies where 20 countries are either in default or trading at distressed levels. Unless market conditions improve, there's a risk of further sovereign defaults in frontier markets. Our global stress tests for banks show that under a severe downturn scenario, 29% of emerging market banks could breach minimum capital requirements. And of course, corporate credit is also facing an increased risk of default. We have also seen turbulence in markets in some specific countries.
Tobias, what is your advice to policymakers?
Central banks must act resolutely to bring inflation back to target, to keep inflationary pressures from becoming entrenched, and to avoid the anchoring of inflation expectations. The high uncertainty clouding the economic outlook hampers policymakers' ability to provide explicit and precise guidance about the future path of monetary policy. Clear communication about the policy function, the unwavering commitment to achieve the mandate of price stability, and the need to further normalize and, in some cases, tighten monetary policy is crucial to avoid unwarranted market disruptions.
Thank you, Tobias. We can open the floor now for questions. I want to advise our viewers also online. You can ask your questions via WebEx. Kindly use the raise hand option to ask your questions. We're going to turn into the room and start here. Let me start. Chris, the Financial Times. Chris Giles. Yeah.
Thank you very much. Chris Giles from the Financial Times. I wonder, this morning the Bank of England's had to intervene yet again with a financial stability issue arising in the index-linked gilts market following the wider gilts market last week. Is the only way of really solving this for the government to reverse its mini-budget unfunded tax plans?
Yeah, that's an excellent question, and let me just put the question into context. On September 23rd, the government announced a new plan in terms of fiscal expenditures, and that triggered rising interest rates. So the rise in interest rates is what would be expected given the change in the outlook for fiscal policy. But of course, some of that rise has been disorderly. So there were spirals, disorderly amplification mechanisms at play that led to a very, very sharp and very quick increase in yields, threatening financial stability. So the Bank of England stepped in with targeted and temporary asset purchases at the longer end of the gilt market, and that did lead to a drop in yields. They are now rising again, and the question that was asked is whether there's ultimately any way to stop the rise in yields unless there's a shift in fiscal policy, right? And so I would say there certainly a change in the fiscal policy would change the trajectory of interest rates going forward, right? Because the expansionary fiscal policy basically triggered a shift in expectations as to what monetary policy is going to do going forward. And with the expansionary fiscal policy, the Bank of England would have to raise interest rates that much more in order to contain inflation and to get inflation back to the mandated objective. So, one part of the answer to the question is yes, the shift in fiscal policy would certainly change the trajectory. Now, you were asking, is that the only way to change the trajectory in yields? And as you saw in the recent past 2 weeks, asset purchases can also change yields in the marketplace. But of course, the Bank of England has the inflation price stability objective, and that is going to stand in the way of permanently having lower interest rates.
This meeting is being recorded.
Adding anything? Or just...
I mean, I can maybe stepping back for a second and broadening the question. I mean, we are essentially seeing almost like regime shifts in terms of macro, right? We moved from a low inflation environment with low rates, low volatility, to an environment where inflation is higher, it's about decades level higher. We see volatility higher, and so markets are fragile. We have seen vulnerability that have been building over the last decades plus, whether this is liquidity mismatch, whether this is financial leverage, use of leverage, maturity mismatch. And so that fragility in some sense makes the financial risk much more elevated. We have seen some pressure on the plumbing. Maybe you can think of the UK episode just as a warning shot. We also have seen waves of stress that is propagated to the system through this deleveraging, that it's affecting UK assets, but it's also affecting assets across the globe. We have seen high correlation, for example, between UK rates and US or European rates. We have seen pressure in risk assets in the US or in other parts of the globe. So I think it's that wave of stress as implication for asset allocation, for correlation across assets. And so clearly central banks should not pivot away from fighting inflation. They have tools they can use to address market dysfunction, and Tobias has mentioned some of them. The repo facility, asset purchases. But clear communication here is crucial, I think, in terms of separating what is done in pursuing optimal, flexible inflation targeting vis-a-vis addressing dysfunction in financial markets. And finally, obviously, policymakers need to be prepared what could be a bumpy ride going forward. Some of these cracks, some of this pressure, some of this wave, those are fragile markets, and that's why it's so important to have a steady hand for these fragile times.
Thank you. Please.
Thank you, Randa, for taking my question. It's Maolin Sheng with China Xinhua News Agency. I have two questions. Firstly, about the Federal Reserve. The Federal Reserve has been hiking interest rate in recent months. How has it impacted emerging markets? And as the rate hike continues, do you expect bigger spillover effect? So secondly, about China's property sector stress, the report made analysis on it. Do you expect that stress to lead to financial instability in China? And what's your suggestion for China's policymakers? Thank you.
Yeah, thanks so much for those questions. So The Federal Reserve in the US has been increasing interest rates in order to get inflation back to its 2% inflation target. We view the part of interest rates in the US as appropriate. So we do view the tightening in the US as the appropriate step to achieve the objectives, the inflation objectives, the price stability objectives of the Federal Reserve. Of course, other countries are also changing their stance of monetary policy. Many countries around the world are also tightening monetary policy. And some of the exchange rate movements are driven by the differential stance of monetary policy. So, for example, some countries have not seen a decline of their currency vis-a-vis the dollar, but it is true that broadly there is a decline of exchange rates vis-a-vis the dollar. And so there are 2 or 3 reasons for that. One is a differential stance in monetary policy. For example, when you look at a country like Japan, where monetary policy continues to be expansionary, while the US is tightening very sharply, so you've seen an adjustment in exchange rates there. Secondly, there are terms of trade shocks in many economies. Europe comes to mind here, where, of course, the imports of energy, oil, gas from abroad has driven to a very large terms of trade shock, and that has tended to put depreciation pressures on the euro. Those are some of the reasons why exchange rates are moving. So most of those movements we currently view as being driven by fundamentals. So there's differentiation across countries. These are necessary macroeconomic adjustments relative to the different stance of policy, relative to different economic shocks. And they are not necessarily disorderly at the moment. Certainly financial conditions are tightening globally. And that is true in the US, it's true in many countries around the world, and there are certainly spillovers of the tightening onto other countries. A stronger dollar, higher interest rates, of course, are tightening financial conditions for countries around the world. And that might well continue going forward as well. Let me also point out that in the report we have a chart on the FX swap basis. So this is an indicator of cross-currency funding pressures, and that has widened as well across a range of countries. Now turning to your second question, which is about the Chinese property market. So we have seen stress in the Chinese property market. Of course, compared to recent years, the growth rate in China has been declining to some degree. And that is one contributing factor to the slowing of the property market. But also, of course, there has been a lot of investment in properties over many years. And so that has also led to a demand and supply imbalance in some regions, in some cities. So when we look at property developing companies in particular, their stock and bond prices have been declining as the prospects for sales going forward, for example, have been readjusted. So sales have been declining steadily. Now, the stress in property markets is, of course, something that the policymakers in China are very focused on, and so necessary policy steps are being taken. But there is the potential for more turbulence. So there's the potential for exposure to the banking system, for example, or to the market-based financial system. And again, we're flagging some of those risks in the report, and we're giving some precise numbers. Fabio, you want to
follow up? So you may remember that the October financial stability report last year, we had a box where we were qualitatively walking through some of the steps and how contagion and spillover effect would work from the property development sector to the real estate, to the banks, to corporates, and to local government. I think what we're seeing here, in some sense, is a crystallization of some of this risk. Right? So Tobias mentioned briefly the essentially liquidity issue in the property development sector turning into solvency issue. We have an analysis of scenario in the report where we look at what happens if the crystallization of earnings decline, if some of the valuation inventories are valued at market prices, and we take account of external financial condition, you would find that 45% of the property developer would be unable to meet interest payments with earnings, and 20% of them would be insolvency. So you can see that liquidity issue essentially is starting to turn into insolvency. In terms of the propagation channel, so spillover, one spillover would be to the banks, right? So banks are exposed to both the property developers, it's about 8% of their lending, and to the real estate for another 20% of mortgages. Now, if you apply and assume that 10% of these holdings becomes non-performing and you lower the recovery value, the analysis shows that 15% of banks, or about 10% by asset, would not meet the 4.5% regulatory minimum of capital. And also there's spillover to the local government sector. A big chunk of their revenues come from land sales, for example. So with declining land sale, the revenues get affected. You see pressure on local government financing vehicles, particularly the contingent liability. So you can see how some of these risks are crystallizing. So in terms of policy and what we advise the Chinese authority to do, I think there's an urgent need for action at the central government level to restore confidence in the housing sector, address financial stability, and prevent some of this spillover action. So, for example, complete the unfinished housing to essentially put the floor on the housing market, restore confidence in the housing market, and also address the business model of the property developer. So it's a combination essentially of financial stability policies as well as structural measures that actually deal directly with the business model of the property developers.
Thank you. Colby Smith, let's say in the middle of the room, and then.
Thank you, Colby Smith with the Financial Times. You mentioned the measures that the Bank of England has had to take in order to ensure financial stability, but I'm just curious if you think this is going to be an approach that other central banks globally are going to have to adopt as they continue to raise interest rates to fight inflation. Is this something that we can maybe anticipate from the Fed? And what kind of communication challenges do you anticipate could come from this?
Yeah, thanks so much for this question. At this point, we don't anticipate these actions being necessary in other countries. But of course, we do flag many vulnerabilities in financial markets. There's leverage in many countries around the world, in many segments of the market, in particular in the non-bank financial system. There are maturity mismatches, liquidity transformation, hidden leverage. And so there could certainly be financial stability problems and market dysfunction in other countries as well. It is not our baseline, but in a downside risk scenario, it could materialize. The kind of tools that the Bank of England has deployed, i.e. lending facilities, lending of last resort, repo facilities, outright purchases of risky assets in the market segment where the dysfunction is taking place. These are classic actions of central banks that is in the toolkit of most central banks around the world. So in that sense, it is classic central banking to do what the Bank of England is doing. It is fully endorsed by us, and but it's not in the baseline for other countries at this point. But of course, there's always a tail risk that financial stability instances or financial instability could occur in other countries as well. It's just not the baseline. It's a downside risk.
Thank you. I'm Joe Bruni from the International Financing Review. My question is, how important is it for the U.S. or the Fed to pound down inflation to 2% with the hikes for financial stability? Is that a good target? Should it be a different one? Has it been discussed as a coordinated thing worldwide as to what the target is because it is affecting a lot of the EM market and exchange rates. So I was wondering whether there was international coordination and there was a target that was being considered to be optimal in that sense.
Yeah, thanks so much. So there's certainly a debate, or there has been a debate around the level of the target, but it's really a debate that was done in the context of very low inflation. So at that time, people were asking whether inflation targets should be higher than 2% in the context of deflationary pressures. Changing the target in the current environment would be unwise because it would feed into credibility problems of central banks, right? So if you're above target and then you raise your target, that is undermining credibility. And we have seen a number of examples of such changes in the history, and generally that has not gone very well. So the 2% target is generally viewed as a good objective. And of course, as I explained earlier, there are spillovers from tighter monetary policy in advanced economies, including the US, but other advanced economies as well, onto other markets around the world. But it is important to note that most emerging markets do have high inflation as well. So a tighter stance of policy and tighter financial conditions is actually appropriate for many, not all, but many emerging markets around the world as well.
Yeah, so maybe one thing to add, I think price stability is a prerequisite, right, for sustained growth and for macro-financial stability. That's why it's so important that central banks act resolutely to bring inflation down back to target. We want to see entrenched dynamics. We want to prevent inflation expectation from being the anchor. Essentially, something that would damage that credibility that's been built over all these years. Also, of communication, it's important, right? So having clear communication about, and this has to be a different kind of forward guidance that was given when we were at zero lower bound. You can't provide the same effective, explicit guidance, but bring clarity in terms of the policy function of the central bank. So what are the objectives? What are the steps to hit this objective? And what is the intertemporal trade-off? And the commitment to bring inflation down. And again, this is a new world. I think we're going to face higher rates and high inflation probably for a while. Going back to the previous question, it's also important to distinguish, I think, between volatility and dysfunction. High volatility is something that it's in markets. Investors will need to start to learn how to price liquidity. It's a different price than when you are at the zero lower bound. Dysfunction, it's another issue. That's when you think about lender of last resort tools to deploy. But again, price stability is a prerequisite to have growth and to have macro-financial stability.
Before we move to the room again, I just want to acknowledge one thing, that we had received a question online similar to the Fed one, so I want to tap onto the Fed. It's from Peter de Tier in Börsen-Zeitung, and he's asking again about the Fed and the stop-and-go monetary policy. So if you want to add a little bit before we extend and go to the room.
Of course. So again, we are very comfortable with the kind of path that is currently priced into markets, which is very closely aligned with the dots of the Federal Reserve policymakers. We are very comfortable with the kind of expected path of monetary policy going forward. We think that this is necessary in order to get inflation back to target, and we do think that is the right monetary objective, is to go back to inflation target in the appropriate time. Of course, monetary policy is always conditional on economic developments, right? So there could be inflation surprises to the upside, for example. There could be worse than expected prints for real activity, and there could be a variety of other shocks globally. And so over time, monetary policy would always take those shocks into account and readjust what the optimal path is going forward.
Okay, we go back to the room, please. Can we get the mic, please? Thank you.
Hey, thanks for taking my question. It's Andrew Ackerman with the Wall Street Journal. You wrote, Mr. Adrian, that there's we have yet to see a global systemic event. So from your the answer to the last question, I take it to mean that you think the UK situation is contained. But I'm just wondering if you could elaborate on or clarify on what a global systemic event would look like.
Yeah, absolutely. As you're saying, at the moment, our baseline is one where economic activity is slowing down, inflation is coming back to target, where interest rates are increasing, financial conditions are tightening, but that is in a more or less orderly manner. But of course, there is a downside around that baseline. And when you look at figure 2 in the GFSR, that shows you our quantitative assessment of how big this kind of downside risk is in the time series. So it shows you how big is the downside risk relative to other historical episodes. And so we are in the worst quintile here. So the only times where things were worse was in times of acute crisis, such as the Euro crisis, the global financial crisis, or the 2020 COVID crisis. So in that sense, we are certainly at a stressed moment. But again, the baseline is one where things continue to be orderly. Now, in terms of spillovers from the UK to other countries, so we have, of course, seen that there are yield movements that are correlated to some degree, but we haven't seen the kind of dysfunction spill over into other markets to date.
Yes, maybe one thing to add. I think the core of the financial system, so the banking sector, is stronger than it was pre-GFC. Right? So they have higher level of capital, better quality of capital, liquidity buffers, the central counterparties. So there's been a number of reforms that's been put in place post-financial crisis. I think they make the system, the core of the system, stronger. However, some risk has moved away to what we call the MBFI, the non-bank financial institutions. And there are some risks that Tobias had mentioned, whether this is liquidity mismatch, whether this is financial leverage, or interconnectedness back with the banking system. We have seen a few episodes where stress in the periphery of the system came back to the banking sector from the back door. So I think that's where I think there are some more concern, perhaps. We have one chapter in the financial stability, global financial stability report that looks at open-ended investment fund and the maturity and liquidity mismatches there. So clearly you need to have visibility. Sometimes it's more difficult to have visibility into this corner of the periphery. There's probably financial leverage that we don't perceive. And the other thing is the cross-border effect, right? Some of it has to do with cross-border impact. And that's why I think international cooperation and sharing information is so important, because something that happens in the periphery of the system may affect other countries as well, either through the banking system or through other channels.
Please. Lalit.
Lalit Jha from PTI Press Trust, and very nice to see you here. Can you give us a sense of India's financial stability situation right now? And you also like to have your comments on India's inflation situation and what the steps that Indian government is taking to address this.
Yeah, absolutely. So monetary policy has tightened in India, similar to other emerging markets as well, where inflation has been above target. And certainly inflation has been above the RBI's target recently. So we do expect further tightening of monetary policy going forward as well. In terms of financial stability, there are some pre-existing vulnerabilities, both in the banks and in the non-banking system in India, that are certainly still there and that are a cause of concern. We have flagged them, for example, in the FSAP, the Financial Sector Assessment Program that we did in India some time ago, but some of these issues remain in India. Let me turn to Antonio to complement me on financial stability in particular.
Sure, thanks for the question. I mean, on the monetary policy side, I think Tobias addressed, the Reserve Bank of India have appropriately been tightening to fight inflation, inflation being above target, and since May, if my memory serves me well, it sort of delivers 190 basis points rate hikes, and we think further tightening is needed to bring inflation towards target. On the financial stability, the issues, as Tobias was mentioning, are long-standing, and they pertain both to the bank and non-bank. And on the banking side, I think the issue is related to have prudent underwriting standards, to have adequate and build further capitals, and recognize problem loans, because that can be a drag if they're led on the balance sheet. It actually be a drag in future lending and the recovery for the banking system, and those we see as the key issues.
I will come to this side of the room, please, Simon.
Thank you, Randa, for taking my question. This is Simon Ateba with Today News Africa. Glad to see everyone again after 3 years. I would like you to talk a little bit more about the financial situation in Sub-Saharan Africa. I know in your report you talked about shocks and vulnerabilities, especially debt distress. many of those loans given by the IMF and the World Bank, of course, it always beats me how you give loans and complain. But if you can talk a little bit about the debt distress in Sub-Saharan Africa and the situation there in general. I know Africa is a big continent. You can give us some example and what you see there and what your fiscal policy recommendations are. Thank you.
Absolutely. These are excellent questions. And of course, we do a lot of work in Sub-Saharan Africa, including in the financial sector as well as on debt issues. So let me first note that the very sharp rise in food prices and commodity prices has hit many Sub-Saharan African countries very, very hard. Most countries are importers of food in particular, and this comes on top of previous crises. The COVID crisis already hit Sub-Saharan Africa hard. Now we have this rise in commodity prices and, of course, the tightening of global financial conditions that we already discussed. So many countries are already in debt distress or are close to debt distress. So they entered the crisis with high debt, with high vulnerabilities, and addressing those debt issues is certainly one of the priorities. Secondly, inflation is very high in many countries. And so that has triggered tightening of monetary policy. There's a variety of shades across countries, but it is certainly also important to contain inflationary pressures. And then finally, I would say that protecting the most vulnerable is very important. As you know, in the World Economic Outlook, we are flagging, and then in the Fiscal Monetary Report as well, which is going to be released tomorrow, we are flagging that extreme poverty has been increasing recently, and so targeted fiscal policies to help the most vulnerable is particularly important in some Sub-Saharan African countries. Now, having said that, of course, in an environment with high inflation, an over expansionary stance or more expansionary stance of fiscal policy is problematic for most countries. So in general, we would want to see that fiscal policy is aligned with the objectives of monetary policy in these circumstances.
Thank you. Please.
Phil Aldrich at Bloomberg News. Just wondering about the Bank of England again and the sort of intervention that they've done. You talked about asset purchases. There is a bit of a problem with signalling because obviously asset purchases have been linked with quantitative easing, which is monetary loosening. We currently have a monetary tightening. The bank seems to be wanting to extricate itself from these asset purchases at the moment and do more traditional liquidity operations. Is there a sort of fundamental issue that the bank is going to struggle to sort of square this circle because asset purchases are difficult to operate now?
Yeah, so let me just say again that so what the Bank of England intended was to arrest market dysfunction in a specific segment of the longer dated gilt market, and that has been reported to be associated with liability-driven investments in particular. So we saw a very rapid increase in longer-term interest rates following the September 23rd announcement of the change in the budget. And, once the Bank of England stepped in, yields came down very quickly, very dramatically. Now, interest rates are rising again, but they are not rising as quickly or abruptly as they were back in late September. So in that sense, of course, the Bank of England doesn't want to see these very rapid dysfunction or disorderly increases in rate rises, but some increase in rate rises, of course, would be expected given the change in the budgetary outlook. Now, having said that, as was already mentioned in the WEO press conference, there's an expectation of more announcement on the budget side, and that would be an important input into how longer-term interest rates are evolving going forward.
Maybe if I can add one couple of things. I think the bank has been very clear that they're not targeting the level of interest rate. Those are backstop operations. They are aimed at addressing dysfunction in the gilt market, whether this is the nominal market or whether the linkers today. But they're not targeting the level of rates. This is just about dysfunction in the markets and preventing the essentially market dysfunction that may turn into a financial stability issue. So avoiding fire sale, deleveraging will have an impact on the market itself. But again, this is a backstop facility. The other point on the communication, it's really important to separate the pursuing of flexible inflation targeting from financial stability mandates. There are different tools that can be used, but communication about the separation of the two and the resolve of the bank to actually achieve the inflation mandate, I think that's something that is very important to communicate.
Please.
Thank you. Camille Shikoya with the Africa Bazaar. I was wondering if you could talk about the role of trade in stabilizing the global financial market. And specifically, if you can talk about Africa, Sub-Saharan Africa and Africa in general. They started implementing the Africa Free Continental Trade. And how can they integrate that into the global economic to boost and also stabilize their economy?
Yeah, thank you for this important question. So trade is generally good for economic growth. So we are certainly supportive of more integration across African countries and of Africa within the broader global economy. We do expect that more trade would be associated with more growth. So that is basically my answer. Yeah.
Okay, please.
I'm Anatol Koletsky from Project Syndicate. You've been asked a lot of questions about Britain, and I'm sorry, but this is not really a question about Britain, but about the spillover. This problem began in one of the supposedly best regulated financial systems in the world. How confident are you that specifically the pension systems in other countries, and particularly the United States, are not going to be subject to the same issues? Because liability-driven investment is actually very widespread in the US as well. So you've talked a lot about the macro implications, but you haven't told us whether you've looked specifically at the American pension system. Just one remark. Back in 2007, the leading British mortgage bank, Northern Rock, collapsed a year before the financial crisis, and this was considered to be a one-off bizarre event, but it turned out to be a perfect blueprint for what happened in the US a year later.
Yeah, thanks so much for this thoughtful question. So we did the UK FSAP, the Financial Stability Assessment in the UK last year. It was published, I think, in February of this year. And when you look at the recommendations, a lot of the recommendations are about deepening the understanding of risk-taking, i.e. maturity transformation, liquidity mismatches, and leverage in the non-bank financial system. So this is, the kind of risk-taking that we have seen in LDIs, fits exactly into that bucket. And of course, the recommendations include to take necessary steps to make sure that risk-taking is appropriately regulated in this segment of the market. So better data, better regulation. We did a financial sector assessment in the US as well. And we also flagged that the non-bank financial system has pockets of risk, and that appropriate regulations of those pockets of risks are first order. And we're certainly flagging, many vulnerabilities in the non-bank financial sector in the Global Financial Stability Report. So, again, our baseline is one where the future is a slight decline in economic activity, a tightening of financial conditions, but these things evolve in a somewhat orderly manner. But there is a lot of downside risk around that. I do want to be clear that these downside risks could certainly materialize, but it's not our baseline.
Yes, and the only thing I would add, the point I was trying to make before, that yes, the core of the system is stronger. There are risks that migrated somewhere else. There are a number of vulnerabilities that have been building over the past decade. Volatility is higher, and we start seeing some warning shots in the plumbing, and there's these waves of deleveraging that go at different parts of the corner. Those are very fragile times. Markets are fragile. Investors need to readjust the way they do asset allocation, the way they think of risk, the way they start thinking about liquidity price, what is the price of liquidity. That fragility, I think, is our concern. A tightening of financial conditions, that it's disorderly, could interact with this vulnerability. It takes you into territory where financial stability is a risk.
Or put differently, so quantitatively, the kind of level of risk that we're flagging at the moment is the highest outside of acute crisis. So, yeah.
I'll go on WebEx for one question, and then we go back to the room. We'll ask Mahmoud from MENA News Agency to ask his question. Mahmoud, go ahead. If you can put on your camera.
You hear me?
Yes.
Yes. I have two questions. First of them, how to address risks in emerging economies, including Egypt, from a strong dollar. The second one is you focus on demand side in addressing inflation by encouraging central banks to raise rates. What about supply side? Can we expect a plan from IMF to raise the supply to lower inflation?
Yeah, thank you so much.
Before we go, Tobias, one more thing. Because we're on the topic of emerging markets and emerging economies tightening, Yolanda Morales from El Economista is also asking about if emerging central banks began early tightening the monetary policy, are they at risk to go too far in an aggressive policy? Can it be a financial risk? So we take together emerging economies. Thank you.
Yeah, thank you so much. So let me start with Egypt. Egypt, of course, has approached the fund in order to ask for a program. And this is one of the roles of the IMF, is a lender of last resort to help countries that are hit by adverse shocks. And Egypt is certainly one country that has been hit by a series of negative shocks. Perhaps Antonio can say a little bit more about that in just a moment. In terms of Mexico, of course, Mexico was one of the countries that hiked interest rates early, and that, as a result of that, has been ahead of the curve in terms of getting inflation to be contained. Is there too much tightening? In our view, the tightening in emerging markets in a country like Mexico, so it's difficult to say that in general, but in many Latin American countries, including in Mexico, we do feel that the tightening has been appropriate, and of course the primary goal of monetary policy is to get inflation back to target. Antonio.
Sure. Excuse me. On the central bank policy, so the Central Bank of Egypt has been tightening monetary policy appropriately and has delivered already since the beginning of the crisis 300 basis points. Now we think the Central Bank of Egypt should carry on, should continue with its task to bring inflation to target. Currently inflation is too high at almost 15%, and therefore widely above the target of 7 plus 2 minus 2%. So therefore, I think the key objective remains that of bringing inflation gradually back to target. And I think that, as well as making sure that Egypt can address the high debt levels and address the issue of gross financing needs. So I think those are the key issues, and we obviously our advice from the central bank is to remain focused on price stability as it's been doing over the last year.
We'll take one more question. The lady with the blue, yes. Thank you.
21st century business hero from China. And considering the global communication is global economy is more complicated and global market is more volatile. From Europe, Asia to Africa, everyone is care about the Fed policy, and Fed has a lot of work to do right now. Do you think the Fed still can be a soft landing? And also the second question, you just mentioned there is no worrisome currency disorder now globally, but as the market expects the Fed could go further, so do you think there could be at some point Asian currency could be a repeat of 1997 crisis? Thank you.
Well, no crisis is ever alike, so it's difficult to think of a repeat of a crisis per se. But of course, as we are flagging in the report, there's heightened risk of financial instability, market dysfunction is something that we have seen very broadly across the globe in March 2020 in the so-called dash for cash. At the moment, we see it more narrowly in the gilt market, a certain amount of dysfunctional market developments broadly. It's not our baseline, but it is a risk, and it is a heightened risk at the moment.
Thank you very much. With this, we end our press briefing. I would like to thank our speakers, Tobias, Fabio, and Antonio, and thank you for coming, and to our viewers online. I would like to also let you know if you have any follow-up questions, please email us. We would like to remind you of the Fiscal Monitor press conference tomorrow at 8:30 a.m. here. Thank you.